Oil. For years, the biggest factors in the price of crude were supply and demand and the strength or weakness of the U.S. dollar. Now there's another consideration to throw into this mix, the Fed and quantitative easing. It's one of the reasons Francisco Blanch is predicting a run-up in the price of oil sometime next year. Francisco is the head of global commodity research at Bank of America Merrill Lynch. He's with me right now. Francisco, you're looking for $85 in 2011, but you've had this forecast going for a number of months now.
Right.
As we approach that Fed policy meeting next month with quantitative easing widely expected, explain to us how you work in those three different factors: supply and demand, plus the dollar, plus quantitative easing, and this demand for risky assets that it is spurring.
Well, I think the first thing to keep in mind is our average price forecast is $85 a barrel, but we do expect prices to rally all the way up to 100. So we do think we're going to touch 100 at some point next year on the basis of all these different factors playing out. I would say the quantitative easing, the way it plays out into the market is quite interesting, right? Because if the Fed keeps real interest rates negative for a long period of time, number one, it encourages people to spend money because obviously your money is worth less every year that goes on. But equally for the producer, right? If you're Saudi Arabia and you have $100 worth of oil in the ground, you know you're going to take them out and have $98 next year because negative real interest rates are playing against you. Why would you take the barrels out? And this is effectively part of the reason.
So it's a disincentive to those
disincentive
producers.
to the producers, and it's an incentive to the consumers. Also, I think the weak dollar, quantitative easing effectively results in a weak dollar, right, through money printing in the U.S., but also results in a transfer of money to emerging economies, which in turn use that money to buy cars and buy washing machines, and that in turn further fuels demand for oil.
Okay, question about the supply and demand. Do you see or do you anticipate that the increase in demand from emerging markets is going to be enough of a counterbalance against what presumably is going on in the developed world with interest rates near zero? There's a reason for it. We're just not growing.
But, I think as long as we are just not growing, I think that's fine. The problem is if we start contracting pretty abruptly. That's, I think, the real challenge. And that's still a possibility. We don't think it's the main central scenario we should work with. We are working with the scenario of 1.8% GDP growth in the U.S., which is still a growth recession. We're still looking for weaker economic activity, weaker employment. But we do think that the U.S. economy is going to hold up, and as a result, you're going to still have some economic activity around.
Francisco, you're the head of global economic commodity research at B of A Merrill Lynch. So let's try and draw a relationship between what we've seen going on in gold and what you expect to see going on in oil. Is part of the run up to $100 that you expect next year a function of people growing a little less enamored of gold and taking some of the money they would put into gold as a commodity and moving it into oil?
Well, look, I think one of the factors we have to keep in mind is that the Fed wants to create inflation, and they are going to create inflation either by printing money or by reigniting economic activity. So it's very important that they create some inflation, but the ultimate impact of this inflation pressure is gonna be seen in oil. So I do think that investors will rotate a little bit over time into oil if QE starts working in terms of getting economic activity back on track. If it doesn't, they might stay in gold for now until we see all the full QE impact coming through. So.
I've heard a number of people make the case for oil as an effective hedge against inflation. Right. Are you beginning to buy into that idea more and more because of the factors that you've just explained?
Well, look, I think oil has always been a great hedge against short-term inflation. Has been probably the best hedge because short-term inflation is very much driven by oil and unexpected inflation. Gold, on the other hand, is a bit of a longer-term play on inflation. And for now, it's been more of a deflation play than an inflation play. Because people expect disinflation now with potentially more inflation later. So it's a bit of a tricky one, but it kind of makes sense I think in the big scheme of things. You will have some upside pressures on both oil and gold as we print more money. I think that's just pretty intuitive, right? If central banks print more money, would you expect prices of things to go up? The answer is probably yes, and they will. And
at this point, it seems almost guaranteed that more money will be printed. Francisco, thank you for joining us and explaining to us the relationship between QE, supply and demand, the dollar, and what to expect from oil. In his words, $100 sometime next year.